Good afternoon, good evening, and welcome to Traders Workshop for Tuesday, March 28th. I'm your host, Tom Schneider, CMT with NinjaTrader, and this week we have a great new guest. I'm really excited to have him on, but before we get into that, I do want to remind everybody that futures and options trading contains substantial risk, is not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose, doesn't keep you up at night, doesn't extend your retirement horizon. I also want to remind everybody that past performance is not necessarily indicative of future results, and what we talk about here on this program contains neither trade recommendations nor financial advice and should not be interpreted as such, but should be taken only for educational purposes. And with that out of the way, it is my pleasure to welcome our next guest, the founder of Emoji Trading and NinjaTrader Ecosystem participant, Lee Harris. Lee, how are you today?
I'm good, Tom. Thank you very much for having me today. I really appreciate the opportunity to be here and talk to your viewers.
Oh, my pleasure. My pleasure. We've had a couple of great conversations, I think, and really interested in today's topic. Before we get into all of that, though, where are you calling from, by the way? Where are you phoning in from?
So I'm in the UK. I'm in a little village called Cookham, spelt like, Cookham, literally. It's about 20 miles to the west of Heathrow Airport, so on the River Thames. Nice little countryside village.
Okay. And, I noticed you said miles, not kilometers, so appreciate
Indeed,
that.
yeah, yeah.
Uh,
We drive on the left.
that's right. That's right. A little different there. What is that? Like 32 kilometers, something like that, 33 kilometers west, but great area. I've explored kind of close to there, a little more rural
Mhm.
parts of London, around the airport, and west. But that's great. So how long have you been there? Have you been there all your life, or is that where you're from? Where'd you grow up?
I was born relatively near to here. I spent, how long did I spend in London? Probably almost 15 years. I lived in London.
Oh, great.
And then I moved back out here around 2013, 2014 time.
Okay, great. And we'd like to learn a little bit more about you and how you got to where you are now, founder of Emoji Trading. What was
Yeah, sure.
your university experience like?
Yeah, well, I've got to go back to when TV was black and white for that. So I studied computer science at university, but for me, university was always a means to an end. It was about getting a degree so I could have a job at a certain level, certain salary level. And after graduating, which was a bit of a struggle, I struggled with that degree. Certainly the maths part, that was tough. I entered the world of IT, mainly telecoms. I had about a 10, 12-year career in enterprise IT and telecoms, pre-sales, technical sales guy. Then I formed my own business in consumer electronics in the early 2000s. But I'd always had an interest in trading around that, probably because growing up was during the 80s. And that's when we had the stock exchange deregulation in the UK, process known as Big Bang. And I saw that going on. I really wanted to go into the city, as a trader. Big brick of a mobile phone and a red Porsche 911 and probably red braces. That sort of era. Gordon Gecko. But I was probably 5 years too late, and I didn't have what I guess I perceived was the necessary either economic background or math capability. But through bizarre twist of fortune, a friend of mine, my first job, he had been what was known as a blue button on the floor of the London Stock Exchange, a runner, and he he actually blew up spectacularly during the '87 crash. He was writing naked puts, and he lost about 100K sterling. The broker he was with went bankrupt during that. My friend was chased down through, I think it's Section 80 regulation, banned from trading, but he got me interested. He got me interested in trades options. So that's when I sort of got the flavor for trading.
Right,
And
right.
and through the 90s, I was just dabbling in traded options, spread betting, which you don't have in the US, but CFDs, contract for difference, synthetic derivatives on equities. But I was never doing it full time. It was only after I exited part of my business in 2014 that I was able to really concentrate on trading full time. And I rented a desk in an educational prop firm in London. And I thought, if I don't see the inside of this and do it properly, then there'll never be an excuse. But my ulterior motive, and this might go back to our theme for today, was after running my own business, I was unemployable. You know, I closed part of the business and I thought, I can't go back to having a job. No one will want me. And I don't want to work for some idiot and deal with idiots. And I got really pure and thought, what's my objective? And I thought, well, my objective is to earn X amount per day. And a job isn't going to give me that. So what will give me that? And actually what can potentially give me that is trading. So I thought I need to look at this properly. I spent some money on a slightly scammy educational prop firm offer that had 2 months of education in the prop firm. And if you were good, they'd take you on. They didn't take me on. So I litigated and got my money back. But it showed me, firstly, what the proper trading environment was like. It also confirms to me I didn't need to deposit money with a prop firm, pay many hundreds of pounds a month to rent a desk and TT or CQG because of this massive leverage that they could offer me, because I could get better leverage with a retail broker in the US and sit at home. But it taught me prop trading as a different skill set and different approach to, I think, the route that many retail traders enter into of get a platform, wiggly lines and TA, and lots of charts, which is what I'd grown up on in the 90s,
Sure.
meta stock and all that. And after a month in a prop firm, I actually sold my copy of John Murphy, Technical Analysis of the Futures Markets, thick book, because I realized I'm not doing this stuff. I'm looking at a dome, I'm looking at volume, and now I'm trading.
So Lee, a lot to unpack there. I want to just kind of revisit a couple of things. First of all, thanks for the history. In the 1980s, there was certainly a lot of glorification in the media and entertainment about, whether it's, whatever markets it was. There were certainly was it Trading Places and Wall Street and all these great movies that certainly would draw people in, right? And then after that, I didn't see much. Right after 1987, you didn't see much in the media glorifying that.
Yeah.
So understand that if your friend blew up and you were introduced, but you didn't really jump in full handle, understand that your path is after you sold your business, coming back to the trading market. Really interesting, and we'll talk about that in just a moment. But also, you mentioned these firms. I'm familiar with a lot of those firms. Whether they're software providers, but you mentioned prop shops. So can you just go over, for those of people who are new to the business or new to the arena of trading, what a prop shop is? Because we talk about retail quite a bit on the show, but if you can just explain, what is the difference between a prop shop and a retail trader?
Yeah, so a prop firm is a proprietary trading firm. It's a firm that trades its own money. It may be that traders within the firm are kind of co-opted in. They might bring some of their own money. But I guess where this came about was with the demise of the physical trading pits and a move to electronic trading, the floor traders, the locals, trading on their own account, wanted some either more resources or some degree of collaboration, community, an office to go to, and in a lot of cases probably help with the IT. These are guys who understand how to stand in a pit and make a market and trade. They don't necessarily understand how to configure a PC and an internet connection and what to do when it goes wrong. So proprietary trading firms, it's only around 90s, 2000s, were in place such that individual traders could trade, either gearing up their own funds that they bought with the pool of other funds and the firm's money, or as kind of quasi contractors or employees, and be paid based upon the results they achieve. And, a few different models. That was the starting point. In the UK, maybe to some extent Europe, you also hear about trading arcades. So these were venues with fast data connections, lots of workstations, lots of screens, classic trading floor kind of stuff that you see. And it was an environment where an individual trader could go and rent space to trade, potentially their account, but get rid of all the headaches of the IT. Now, since that time, the phrase, the term, has probably changed. A little bit. The understanding that the term has changed a little bit, because some of these prop firms ended up running, physical evaluations. Let's run a recruitment drive. Let's see how you perform. We might bring you in as a trader. Some of them would offer associated education, and the place I joined was basically an educational shop making fees off education, doing a little bit of prop trading after the fact. And now, we've seen in the past, well, there's been an explosion of this in the past 3-4 years, but probably starting about 10 years back, we've seen online trading evaluators, lots of them in the Forex world, probably about a dozen in the futures world, who now present themselves as prop firms. But in reality, they're trading evaluators. If you can pass their test, which you pay for, they may give you a funded or a synthetically funded, a live simulation account from which you can make money. So you can learn to trade without putting your own capital at risk, but you'll be paying evaluation fees, and anything you make downstream might be subject to a profit split. So the term has slightly changed in its application, but the idea is, here's a firm that trades its own capital. Traders come to it. They've got to qualify in some way to be able to trade in that environment. And their earnings will be subject to some splits with the firm itself.
Right. And that kind of falls in line with, well, if they're providing the IT, the equipment, the resources to make your decisions, right, whether it's paying for data or paying for news services, that would be a benefit of these prop shops. Although I would argue for the retail trader, the cost of these items, right? You can trade at home. You don't need a huge connection because the internet is fast enough. You've got these news sources, and then through, hopefully through your brokerage, you have live data, right? You need live data to trade. So
and the world has certainly come on for the retail trader even since 2014, 2015. If we go back 10 years.
Sure.
But you think to the early, the mid 2000s, I would say for futures, there wasn't really this retail trading environment, which explains why, as the pits were in demise, these venues and these firms were sensible for people exiting from trading pits as a place to go. But my learning was, I don't need a 50% profit split. I don't need £2,000 a month bill, and I don't need a risk manager shouting at me if I don't get to my desk before 7 a.m. after having a 4 a.m. alarm. I don't need to pay for that.
Right, for sure. Now, one thing you mentioned too that I think is kind of in line with what we want to talk about today is your goal, right? So you sold your business, or you got out of your business. You found that I can't go back working for a company. I'm going to work for myself again, but I need a goal this time, and maybe not this time, but what is my goal? And let's talk a little bit about that, and achieving that goal, I think, is the purpose of this show.
Yeah, I think it's really important to regard your trading as a business. Ultimately it generates income. It's a fascinating endeavor and pastime, probably one of the hardest in the world, to be successful at. You can do it for fun, but at the end of the day, if you're doing it for fun, you're going to get the results that come from doing something for fun. I think, it's a serious endeavor. It's got elements to it like strategy, like planning, like infrastructure, lots of risk. So you can't take any of these elements casually. And I see a lot of, you see a lot of hopeful, aspiring traders who come to it lured by, I can make a lot of money really quickly. And, that's the massive churn through this industry. But the people who actually are successful have a pretty long learning career. I'd say it's 3 to 10 years in reality to get to a point where you are consistently profitable, or have a chance of being consistently profitable. You can still go mad psychologically in your head. The monkey, as I like to call it, can still take over, however good you are. But for whatever reason, many people think I can download some software, I can find a free indicator on the web, I can deposit $100 or sign up for a trading evaluation, and because I'm smarter than the average bear, I'm going to be magically successful. Yet, what other endeavor do people come to this in the same way? You don't sit down to Steinway piano if you can't play the piano and think, I'm going to be the next concert pianist with my YouTube guide. You don't walk into the gym for the first time and try and squat 305 pounds. Yet trading, everyone thinks they can just come to it. I found, we like to call it the AlgoBot 9000. I'm applying it to my charts and, I'm in the money. And that just doesn't work. But for some reason, human nature puts a lot of people in that bad place.
Well, and I think it's not only human nature, but again, going back to some media, whether it's in trading or in other areas, like I find this in sports too, and I'm a little bit of a sports fan. You hear the stories of people who excel and they cut out the part of the work, right? So
Yeah.
you hear about the person, maybe it's a golfer like Tiger Woods, he makes these awesome shots. Well, you know what? He's been golfing since he was 2 and he did it every day, right? And you gloss over that. You talk about the trader that made this amazing trade. Now we're seeing it with betting, right? I see it on social media. This person made a huge, a ridiculous bet and it paid off, from pennies to the thousands. And it's like, okay, we tend to glorify the quick wins, the get rich quick stuff, and not realizing you look at the people who are still in trading, for years, they're not getting rich quick, right? They're getting rich slow, or they're doing something consistently rather than looking for that home run, that lightning strike trade.
Absolutely. It's the 10,000 hour thing that Malcolm Gladwell speaks to. I say to my clients and my students, and this is a learned skill. And there's a lot of learning to do, and the beauty of the learning is it tells you what you can throw away. But there's a massive amount of frogs to be kissed as you're learning until you find the prince that works for you as a trader, and then you should be able to have a relatively simple, relatively dull, boring trading existence, doing as little as possible. We don't need more, we need less. And the way I see it, actually, your job after that point becomes more R&D. If you find 1 thing, 2 things, 5 things that work consistently, you keep doing that. And then in the time around that, you're doing research as if you're a fund manager. What else can I put in my fund? How does this perform compared to something else? I want a team of 5. I'm always going to have 3 candidates in recruitment. And I'm going to be measuring, and I'm going to chop the worst 2 or 3 until I can justify having 8 workers or 10 workers. And that's how you run a business. But that takes thought, and it's dull and it's work, and that's not exciting. That's not the home run.
Right, of course. And, running trading like a business gives you that discipline to overcome that boredom, right? I mean, it is, I won't say it's dull. Trading is exciting when you're actually trading, but I always say, if we were to give a course, 1 day would be just learning how to sit on your hands, physically sitting on your hands for a day, right? And overcoming that urge to do something because you're a trader, because that's what you're supposed to do.
This actually is where the educational prop firm environments, of which there aren't really that many now, is quite good, because they tend not to recruit anyone that's had retail experience of trading. They are looking for the freshest, most trading ignorant graduates, because there are no bad habits, no entrenched beliefs. And there are various drills which and I'm sure people listening will know of, things like 1-tick drill, cut and reverse drill. You get good through practice. and repetition, which is the same for any sport or any skill. I have a client in my educational group. They did 10,000 one-tick drills. They did 100 one-tick drills a day for 100 days, logged all their results, different times of day. And you know what? They're good. They're consistent. One of their trading approaches, they call it the Benjamin challenge. They will think, well, the one-tick drill isn't a trading strategy, but it means you're getting really good at entries, you're really good at cutting losses, and if your entry is good, you're pretty much guaranteed a tick. So it gets you good. But they also applied it to, if I want to make $100, I need 13 one-tick trades on ES because, $12.50 net $5 commission, whatever. Can I get 13 winners in a row? They can do it every day. After that, it's just a question of size. Do I want to make $1,000? Fine. Do it with 10 lots.
Right.
So it's about practice
and it is
discipline.
Right, exactly. I just want to remind everybody who's viewing, the chat is back up. You can go to ninjatrader.com. If you can log in, if you already have a login, just go to the learn button on the left. If you don't have a login, you can go to get started. To get that login, all you need is an email address, and then you can click on learn. The chat is there. I just want to, bring to the forefront a comment that one of our regulars on our bookend shows, Turtle, he's in the Chicago area, just outside the Chicago area. He says he treats his trading like his desk at home is a trading desk at the Board of Trade in Chicago. So, sitting down at your desks, treating this like a business, like you're in an office, even though we're not, we're at home, right? But treating it like you are at the office, at a job, at serious about making money. Turtle certainly says that's what he does, and Anissa, thanks for coming again. Agreeing with that. So I think there's very much how serious you take this trading starts right here in front of your screen.
Within my educational group, I mean, we have the concepts of you play two roles. You've got a trader role, which is the person sitting in front of the screen, doing your analysis, whatever that may be, making decisions on trades. You've also got a general manager role. And, a prop firm will relieve you of that because, there's somebody who's bringing you funding, there's a risk manager who's going to shout at you and send you home and whatever else. When you're doing this for yourself, that doesn't exist. And you go, oh, okay, I'll put a loss limit to my broker on my platform. And so it's only one phone call to the broker to override that. Or it's only, well, let's go into that setting. I only need another couple of $100. It will be okay. Boom, $5,000 down day. So there is absolutely a general manager role that you have to flip into to go manage the trader. Meanwhile, the trader's got to keep the flipping monkey brain under control as well and be aware of when he's coming out to play. So just having the appreciation that there are different tiers to this endeavor if you're going to have a chance of being successful is really important. It's not just a case of, firing up your platform, wavy line chart, magic green arrow, buy, wait and hope, because that's not running a business. And no business, whether it's, a restaurant, a car dealership, whatever, no business works in that way. They all have a plan of some type and tiers of management.
Sure. I'm getting a sense you're not fond of risk managers. Is that the case?
The risk manager in the firm I was in, we didn't really get on that well. And I can attribute it to one conversation, which was at the time I was trading Eurex, so the Bund, Euro stocks, and we had to be at our desks at 7 a.m. Just ahead of the futures open. So that's 8 a.m. European time because we're an hour earlier in the UK. For me, that meant I literally had to get the first train from where I was living, which was about a 4:35 a.m. train. So alarm at 4, splash my face, cup of tea, get out of the house. And that train was slow. To cover 20 miles, it was stopping at every stop and taking about an hour and 20 minutes. If I was able to get to my desk literally for about 7:10, I could have got a faster train and I could have got up at 5 and the extra hour in bed was valuable. And said, no, you've got to be at your desk before 7 because you're going to make 20% of your money trading the open. And I said, yeah, but I'm happy with 80% and an extra hour in bed. And at that point, our relationship kind of fell apart.
Oh, that's rough. Yeah, I know. When you live that far outside the city, you really are beholden to the train schedules. As we
Yeah.
are out here on Long Island to some extent. So,
Oh, yeah,
oh
that's a long
boy,
journey in. Yeah.
yeah. So okay, so that's interesting. Um, so you've got this plan. Let's say we're taking trading as a business. We've got
Yeah.
these roles that we're aware of. What do you do to, let's say, where does the planning start, the business planning start for you?
Okay. That's a really good question. We obviously have capital at risk, or maybe we're using a funding evaluator. We've got an objective to pass, or it's a synthetic funded account. We've got synthetic capital, some available drawdown. So we immediately know our resource constraints and our risk. So we've got to think about that. And risk management is the most important thing. For me, though, it's looking at I can almost kind of align trade setups to the products that you would have in a business. How do we generate revenue? Successful trade setups. But annoyingly, for us in this business, not every product that we sell actually makes us money. We can have products that fail and cost us money. Losing trades, cost of doing business. It's unfortunate. So we've really got to be strict on researching and defining our potentially consistently profitable trade setups, those that have an edge, those that are frequent and repeatable, and those that we're physically capable of executing. So around the constraints of our accounts, we need to look at, when am I available to trade? Am I doing this full time? Is it around a full-time job? What am I able to do and in which market with the resources available to me? But what's crucial is having a playbook of setups that you've researched and curate, and long term, if you remain strict to the business process, which is hard because the greed monkey gets in the way, then you are able to run the business. But that's really dull. For me, a lot of it starts with statistics. I'll look at the particular markets which I trade. I'll look at the structure of those markets. So I'll use tools like Market Profile as a way of understanding, how does the market do its thing during the trading day? So, for me, every trading day is an individual day from the Globex Open through to settlements. And I start to look for repeated events that occur during the trading day. Now, how you trade them, you can trade an event, you can trade a level any way you want. If we know that the overnight range is broken pretty much every day on one side, well, we can wait for it to break and we can fade it. We can go with the break. We can trade towards the break. There's lots of things you can do. But the starting point has got to be what happens consistently and repeatably that I'm able to see and act upon in order to start to generate a setup.
Right, and that's the research part, right? So,
Yeah.
for new traders, for people starting out, I would imagine you'd advise to pick one market to focus on,
Mm-hmm.
and then expand into different markets, which also takes time, right? So this isn't something that you could just sit down at the screen like you said and just start trading off of squiggly lines, right? It's technical analysis, my thing.
Although a lot
But
of people unfortunately do that, they turn on the chart any point of time. Oh, head and shoulders, let's trade it.
right, without understanding the dynamics of that market,
Yeah.
and markets are different, right? So even within stock index futures, we were talking
Mm-hmm.
before the show, and we noticed you noticed something about the Russell that was different from the other stock index futures, but amongst different asset classes, right? You have to
Yeah.
know which times they trade, which ones are more global than the others, like gold and crude.
Yeah.
There seems to be a little bit more I wouldn't say activity, but more motion, more directional motion across all three trading zones,
Hmm.
versus something like the S&P or a European stock index where you
Yeah.
see the most activity during its main area where it trades. So it seems like, it's starting out in one market, and then when you feel comfortable doing that same process, but for a different market. So you can give yourself the flexibility of, well, this market, I don't see any setups. I want to
Mm.
move over to this one because there might be more opportunities when you don't see opportunities in another market.
Totally, and something you've mentioned, I was going to bring up. It's crucial to know the product that you're trading. You can look out on social media, on any given federal holiday, and you're going to see posts from people going, "Why aren't my charts moving?" Because it's Memorial Day, and okay, you don't need to be able to name all 500 constituents of the S&P 500, but you've got to understand tick size, trading hours, rollover dates, because you're not trading this thing that produces candles. It is a contract, and it has got attributes related to it. So you need at least some awareness of those attributes. You need some awareness of economic releases that can affect things, or can affect the instrument you're trading, when those are. So a little bit of situational awareness, domain understanding is important. Otherwise, you're really going in very blind.
Sure, sure. No, we try to promote that all of kind of give a well-rounded look at what's happening in any given market as best we can in the
Yeah.
45 minutes or an hour we have every day on each side. So, great. So let's say we've picked our market, right? Let's say you've
Yeah.
done your research, you picked your market. What's next?
So for me, and really because I do decent amount of education, I spend a lot of time on ES, because that's what most people are drawn to in their trading. So for me, my focus tends to be ES, the other equity indices for correlation. I do look at CL and GC goals a little bit. I'm not so much focused on other geographies. Trading during the UK afternoon suits me quite nicely. Um, but with a given market, let's say ES, what I tend to do is, well, how I came to this. I'll take you on a roundabout route, as to how I came up with the process. I used to go to Vegas a lot for conventions, CES. And my grandfather was a bookmaker, and it was always drilled into me, never gamble, never gamble. And after probably my 15th convention in Vegas, I thought, why am I paying $15 for a cocktail before dinner when there are
Sure.
people sitting there getting them free? This doesn't make sense. So I started studying basic strategy for blackjack, thinking, okay, I get this, that it's a cash flow game and I can get a free drink. And I got into card counting. And I remember, I was fine with that. I can play blackjack with a 0.5% edge and get free drinks and comps. That's fine. It's really dull. But I then thought, how can I turn trading into a similar process like counting cards? So I know the statistical edge. Doesn't mean I'm going to win all the time, but how can I really have stats on my side or something to lean on to support my decisions? Otherwise, the organic matter gets in the way, and you get into emotional trading. But if I can lean on the framework of stats and manage risk within that, then I should be in a good place. So I started looking, well, and then I thought about, okay, let's take ES, where we know we've got Globex and it trades overnight. We've got NYSE, which opens at 9:30 Eastern and closes at 3 p.m., 4 p.m. Eastern. So there are certain events that happen all the time during the trading day. And actually on any market, there's certain events, whether it's underlying or another geography is underlying open. And I thought, okay, let's start to study what happens every day and look for patterns. So I started looking at concepts like the initial balance, the first hour of regular trading hours and the range that's formed. And for me, one simple stat you can come up with is if we look at ES, then the first hour's range of regular trading hours is broken on at least one side 98% of all trading days. So, okay, that's 2%, 4 days a year, which are going to be the holidays, most likely, where this range doesn't break. So that immediately says to me, okay, if the range has formed and it hasn't broken, as we come to it, don't fall into the trap of professionals always fade the edges, because this thing's going to break 98% of all days. So, there's a little guide of something not to do. And then I start thinking, okay, but if we know that at least one side is going to break, all, in quotes, I have to do is try and determine which side is going to break and how can I exploit that. And I much prefer trading what I call inside out. So from the middle of the range to the edge that's going to break, and I want to get out before it breaks. So I don't want to get caught up in the noise of the litigation of that level. Whereas a lot of chart-oriented traders, breakout traders, they want to trade the breakout at the time of the breakout. And what I actually I want to be exiting my position before there's a breakout. I'm not fading it. I'm in with a directional bias, knowing at least one of these sides is going to go, and this is repeatable. So I spend quite a lot of time looking at ranges like the overnight range, the initial balance, lunchtime, 12 to 2, the weird time when volume goes down, and understand what's the behavior of this market when it forms a range after that time-bound range has been formed. And if I can find an event that happens frequently, then I can start to look for setups around that event.
Okay, so understanding that you're breaking down the day into different time periods,
Yep.
did you get to a point where you found that at a certain point, breaking it down, let's say hour by hour, half hour by half hour, did you go down to that minutia and
Yeah, totally.
or small time slices and find a pattern that you could, did it ever break down at a certain granularity, I guess is my question.
I use market profile, not in depth. My market profile is very retrospective and very verbose when you read people's commentaries on it. But I use some of the concepts within it as a simple and quick framework to express what's going on during the trading day in 30-minute periods. So I tend to be looking at the market in these 30-minute periods. The setups and the stats I really like, and if I take ES, and there's no great secret on this, if I think about, for example, the overnight range, that's broken on at least one side pretty much every day. And by the way, it's broken during the first 30 minutes of regular trading hours about 55% of the time. During the second 30 minutes, that hasn't broken already, it's about another 15% of the time. So now, within my business, I don't want to be sitting staring at a screen to trade for the whole day. I want to get this done as quickly as possible and get on with better things. If I know the overnight range has got about a 70% likelihood of breaking during the first hour of regular trading hours, now I've got a job. And I started looking at that time period. I then started looking at what I'd refer to as B period, the second period of regular trading hours, so 9 to 9:30 Central. And actually, B period breaks A period's range pretty much every day on at least one side. So I've got a job during the first hour of looking at the overnight range. I've got a job during the second 30 minutes of looking at the first 30-minute range. At that point, the initial balance has formed. So by the way, the initial balance will break in the first 30 minutes afterwards, about 55, 60% of the time. There's another job. I can break my trading day and let's say the setup opportunities down into about a 2-hour window of regular trading hours. Now, they won't always happen every day. That's fine. I might not always get it right every day, but I can at least come to my place of work knowing the job that I'm looking to do. And I'm not sitting waiting for a particular graphical pattern to form, or this indicator's crossed this threshold on this arbitrary X minute or X tick or X reversal period chart. I'm trading in a way which is aligned to the structure and the rhythm of the market, because what we can't escape from is Globex opens at 5 p.m. Central. NYSE cash opens at 9:30 Eastern, and there's settlement. Now, that, if you like, is the only truth of what's going on in the trading day. If we choose to look at a chart that's divided up by 5 minutes or 10 range or 610 ticks or 173 delta, the market doesn't know about that and it doesn't care. It's an arbitrary model. And to my mind, as soon as you do arbitrary, it's wrong. Yeah, it's the model you're using and the lens you're looking through. The only truth is Globex open, cash open, close. So I like to work within that framework because there is nothing arbitrary about that whatsoever.
Interesting. So, one of the things Jim and I have talked about is some research I did, which was slightly different. Opening range information with the constituents of the S&P 500. And this was years ago where I had the resources to do this, looking at the opening range 30 minutes versus 60 minutes versus 5 minutes versus 10 minutes, and trying to figure out when you sacrifice time for percentage, right? So, after an extra half hour, that initial balance in terms of market profile terms, what do you gain, right? Well, you gain about another 2% of certainty of what I was looking for, which is if it breaks one way, it won't break the other, right? If it breaks the opening range top, it won't break the opening range bottom most of the time. So that's interesting that you were looking at it in time slices. Okay, let's do it as a progression. This initial balance compared to the overnight range versus the first half hour, second half hour. Sounds like 2 hours. People talk about, I don't really have to trade all day, right? I could trade, where the volume is, and then, that frees me up to do exactly what you said, which is do some more research.
And I'm sure you found it. The trading days where you get drawn in and you are sitting in front of the charts for 5, 6, 7 hour days, these tend not to be the best days. Partly you're getting tired. Emotion starts to come in. You make weaker decisions, or you're chasing, trying to make up losses potentially. And I did a bit of analysis on what my return on time invested was. So what's my revenue profile if I'm trading 30 minutes or 60 minutes or 120 minutes, or what happens when I see it all the way through and I leave my desk at 9 p.m. UK. And my hourly earnings were no different if I was trading a longer day to a shorter day. And actually, my bad days occur when I trade longer. And the reason for this, none of us have got 100% expectancy on any trade. We don't have a 100% win rate. Okay, if we've got infinite drawdown, we might do, but we don't. So I regard every trade you take is an opportunity to lose money. The less you do, the safer you're going to be. It's not really a case of the more you trade, the more you're going to make. Well, no, the more opportunity for loss you're exposing yourself to, let alone if you've been doing this for 7 hours solid and you haven't left your desk. And when I realized that my hourly earnings were no different, whether I was trading 2 hours or 5 hours or 30 minutes, it reinforced to me, hone your setups, get good at them, and then it's just a question of scale and size.
I love it. I love it. So, Leah, I mentioned yesterday when we spoke, this would go by real fast. We didn't even get to any charts or anything, which is completely fine. Means we'll have to have you back on again. But I do want everybody here, and thank you, viewers, for coming in and watching Traders Workshop this week. I do want to give everybody a chance to follow up with you. Where can they find you if they want to, learn more about what you do?
So I have a couple of trading related activities going on. One of them is emoji trading, which is how you're name checking me today, and that was actually the commercialization of tools that I wrote for myself to look at patterns in the traded volume, the order flow. Because I've got a background in product development and software, so I thought if I write something for me, hey, let's monetize it. So you can visit emojitrading.com and look at some of the pattern recognition tools that I've written. We even have a free footprint available from NinjaTrader if you want to get into volume at price. But bizarrely, for somebody that's got an income stream from tools, I don't recommend that anybody starts with tools. I recommend that people start being able to read patterns in volume at price from the raw data, the footprint, the volume profile, this kind of thing. So I'm co-founder of an educational group called Trading Research Group. So that's tradingresearchgroup.com. And we have got online courses. We've got 4 courses as a kind of foundation level. There's 100 online learning topics there. We charge a small fee, $25. It's important people have a little bit of skin in the game. Otherwise, people take it free. They spend 30 minutes going through every lesson. They don't learn anything, then go, that was useless. But if you visit tradingresearchgroup.com, you can look at our online courses that will teach you how to read everything that's important in price action and volume at price and the footprint, and give you a taster of how you start to build trading setups. And we've got a student community, we've got a second tier of members. So I'd recommend to everybody, before you get turned on by all my exciting visual tools at emojitrading.com, hold that thought, go and read the brain dump from Jeff, my co-founder, and me in our online education at tradingresearchgroup.com, and put us in a position where we can help you understand things from first principles, so then you can make really good use of tools after you understand things from raw data.
Awesome. Thank you, Lee. That is great. And you're on the NinjaTrader ecosystem
Yep.
As well. So you can look for Lee Harris there. But I want to thank you for your time. I know it's a little bit later where you are from where we are. So appreciate you spending the time and just having this discussion with us.
That's a pleasure, Tom. Thanks for having me. I appreciate it.
No, thank you. And I want to thank all the viewers for coming. And we'll be back here. Jim Cagnina will be back in the afternoon, finish up with bars closing. In the meantime, have a great trading day.